Welcome to the Market Recap, your weekly digest of the biggest market stories from the past week. Join host Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
And I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap on Friday, April 29th. I am not joined by Bruce Campbell today. I'm actually joined by Jordan Youl. I always love having you here, Jordan. Of course, Jordan's with Stonecastle Investment Management. Typically, Jordan, we see you on a quadruple witching day, but I don't believe that is today, is it?
It's not today, but it's been a volatile week for sure. But it's good to be back.
We're gonna have to get you like a witch's hat or me a witch's hat for those special days when you join us. Well, it's very nice to see you. I haven't seen you in a little while. Thank you so much for joining us. Of course, there's lots going on in the markets this week. This is an important week for investors to make sure that they're reading up and doing their due diligence because there's a lot of factors that are possibly affecting their brokerage accounts. Okay, so we're going to talk about struggling equity markets. We've obviously seen lots of movement there. You're going to tell us what's going on because there's so many factors affecting it. We're going to talk about the Fed raising hikes again. I feel like we talk about this a lot, and we're going to talk about it more. We're going to talk about investor sentiment. Obviously, people are feeling a certain way about this and how that's affecting the market. And then, of course, we're going to get into some CSE issuer news. So let's talk about equity markets. What's going on, Jordan?
Yeah, this week in particular has been quite volatile. We've seen the VIX index get above 30, which is a synthetic derivative of the S&P 500. The narrative, year to date continues to be more risk off. That's not new, but without question, we've seen an uptick in market volatility this week for equity investors. And that really coincides with the macro narrative and the theme. We're fighting multi-decade inflation. The Fed is coming up next week on Wednesday, when the market is also anticipating that they're going to increase rates by about 50 basis points, which we'll touch on momentarily. But, a third of the S&P 500 constituents also reported this week as well. So the market is really trying to digest those numbers, not only what, the companies reported, but what their expectation is moving forward, dealing with, the current economic backdrop right now.
Well, and do you think this is something that will carry on, into the summer? Because obviously this time of year, typically we start to see things taper off a little bit as we move into summer. But we also are dealing with the fact that a lot of conferences and a lot of financings have kind of been pushed out a little bit just because we were under lockdown in the beginning of the year. So now do you think we'll see the same symptom of spring?
I believe so. Personal views. What would change that narrative is if our indicators switch from more neutral defensive to more, neutral offensive to offense. And what I mean by that is anytime the market is dealing with a variety of different cross currents and narratives, day to day or week over week, we like to take a look at the longer term trends of the market. And we look at breadth and a lot of different market technical indicators to try and gauge, the sentiment of the overall market. And in our models, it's still neutral to neutral defensive. So we are heading into May now. Today is month end for rebalancing and whatnot. But typically, that there's that old adage, sell and may go away, where, we might see some weaker performance, but the longer term indicators are still indicating, more risk off. So it's a little bit more difficult to time, how long this is going to last with volatility and some uncertainty and whatnot. But typically in a midterm election year, the markets typically have a stronger second half. So I think that's the time frame that you want to be probably focusing on, is the second half narrative going into 2023.
Right. And there's lots of ways that you can protect yourself until then. That's obviously why we seek professional advice such as yours. Okay, let's talk about the Fed. So looks like it's going back up. What's happening?
Yeah, so as expected, the FOMC, they're releasing their minutes on Wednesday next week, and Fed Chairman Jay Powell is set to speak on Wednesday. But it's been telegraphed for quite some time that the Fed is going to increase rates more aggressively. The Fed specifically is in a tough situation because, yesterday, the year over year Q1 results for GDP in the US missed. Consensus was expecting a 1.1% increase, but in fact, yesterday it reported a negative 1.4% decrease. So the question and the challenge that investors are facing right now is if the economic backdrop is slowing down, the Fed could be increasing rates while they're fighting, inflation, which is at a multi-decade high effectively. So they're really in a tough situation where, they're trying to combat upward inflationary pressure, but possibly going into an economic slowdown. So the market is definitely anticipating a 50 basis point hike. But this morning, and we do have a chart that we'll reference, did show and indicate about 1% probability that they actually might increase not only 50 basis points, but 75 basis points as well. So that's something that we're watching very closely right now, but the market is anticipating a 50 basis point hike on Wednesday, but really the takeaway is going to be the comments after they make that announcement.
Wow. Well, yeah, I mean, I guess it really comes down to when there's difficulties kind of in the economy, they usually will ease that rate pressure, right? But they're kind of in a position where they have to raise them because inflation is just getting so out of control. So so they're a rock and a hard place. Is that what you'd call it?
Yes, without question. And, if you go back maybe a year ago or maybe 9 months ago, the Fed indicated that, rising inflationary pressures was going to be temporary or transitory. But as we all know, that's not really reality or what the case. So they are definitely behind the curve without question.
Yeah.
But given that, U.S. unemployment rates around 3.6%, up until recently, the economy was doing quite well. Whether you look at the US LEI index, which reported a couple weeks ago, that increased from last month. Rates effectively should be higher than where they are right now. So
Gotcha.
yeah, they are in a tough spot right now.
So expect more. Now, on all of that note, let's talk about investor sentiment. There's obviously a little bit of pessimism out there in the markets, and we're feeling that as well with equity markets. What's going on?
Yeah, so effective right now, investor sentiment is at extreme levels, levels last seen since March of 2009. Now, there's a few takeaways here. At Stonecastle, we follow a variety of different sentiment indicators. We like to track the pros, so the North American Active Investment Manager Index, to get a sense of what their U.S. equity allocation is or what their exposure is to equities. Right now, that's around 45%. So they do have cash on hand to put to work effectively. We also want to take a look at the RIDEX fund flow to determine, where is money going. It's one thing to do a poll and say, you're bullish, but you might only be 60% invested. So we actually like to track what people are actually doing with their capital, where they're allocating. And you can, look at different put call ratios or other factors to determine what people are actually doing with their money. But we do have a chart of the American Association of Individual Investors, and that's retail investors. And effectively, right now, the extreme pessimism is at a reading last seen, since 2009. Like I mentioned, it's extremely pessimistic. And typically, from an investor perspective, from a contrarian perspective, this is quite positive. So anytime investors are too pessimistic, it typically signals that we might be in a temporary bottoming process. Now, we'll figure that out in hindsight after the fact when we look back on this period. But, previous examples where sentiment was extremely pessimistic and washed out was December Q4 of 2018, and more recently, the March low of 2020 during COVID. And we're there right now too. So we might, the silver lining is that we might be in a bottoming process, but who knows, time will tell. But without question, investor sentiment is extremely pessimistic right now.
Well, hopefully there is a light at the end of this tunnel. We're going to get into some CSE issuer news and a bit of a broader topic that I wanted to chat with you about. So, Labrador Uranium, it just closed a $10 million bought deal, and the proceeds of that will be used towards exploration and development of their property in 2022 and 2023. Labrador Uranium is just like it's called. It is a uranium project that's out of Labrador, Canada. So I wanted to mention, so congratulations to them. This is a great financing. It's within Canadian borders. Uranium is a really interesting commodity right now to discuss or to talk about. I did want to just remind everyone what a bought deal is. So a bought deal, typically it's a nice sign for the company, because what's happened is the underwriter, the person who's raising the capital, the brokerage firm, has basically taken on the $10 million financing, whether they can put their clients in it or not. They're committing to it. So it's really nice for the company because they're guaranteed to get that. And it just shows, I believe, some strength in probably the project and what the company's doing, for the finance or the underwriter to be able to kind of go, we're going to do this no matter what. So that's great. It was just what you see is going on in the uranium market. Obviously, uranium is it's on a lot of headlines right now in the news, and I know that it's being affected because of what's going on in Russia. So, what's your thoughts on uranium?
Yeah, that's some great points there for sure. We've been following the uranium market quite closely. In fact, we've owned quite a few issuers in the past. And in terms of this issuer that just recently announced that bought deal, a lot of their peer groups have been performing quite well as of late, which is fantastic. But without question, demand is very strong right now. The underlying spot price for uranium is at an 11-year high right now. But obviously, with Russia and the invasion into Ukraine, it's going to create a lot of opportunities, because Russia, in particular, from a geographical perspective and from a market perspective, is around 43% of the uranium market. And obviously, with sanctions in place and issuers looking at alternatives, that's going to create a lot of investment opportunities domestically here at home. Case in point is, the Biden administration just invested or announced that they were going to fund $6 billion into uranium plants in the US. So that's going to possibly de-risk, investment, given that, companies are looking at, producing and investing here at home, as opposed to dealing with geopolitical tensions and all the uncertainty going on in Russia.
Absolutely. Well, I always love to see one of the CSE issuers have such a successful financing, but on top of which, it's nice to see a financing on a project that's, within our borders, especially what's going on in the world. Jordan, what should we think about going into next week? Next week is May.
Yeah, exactly. Sell May, go away, right?
That's right.
We'll see more issuers report next week. So we'll continue to focus on earnings and look for, company level catalysts. But I really think, the market's really going to pay attention to the Fed and what's going to happen on Wednesday, and what the aftermath is after, they expect a 50 basis point rate hike, and the comments after from Jay Powell. We obviously want market breadth to improve, right? If you take a look at what's been leading the markets, it's been predominantly energy and the defensives like consumer staples, telcos, and utilities. Whereas on the flip side, technology, cannabis, industrial, discretionary have really struggled. So we like to see some buying power or some money flowing back into other sectors of the market, and that'll kind of really dictate, where the market goes from here. But we want to see market breadth broaden out as well as we go into next month.
Let's hope for that. Well, listen, Jordan, it's always a pleasure to have you. Come back and visit me anytime. Bruce can take a day off anytime, because I always love chatting with you. You have a wonderful weekend, and we'll talk to you soon.
Thanks, same to you.